Morning, everyone. Good morning, everyone, and welcome to the investment panel session at the annual NWR Virtual Healthcare Conference. Thanks to Maddie and the team for putting this event together and making it so easily available for everyone. I believe there'll be recording, so if you can't catch it all now, you can catch it at a later time. We've got a great panel here. We're going to talk biotechs, try to give you some guidance, some, I guess, bit of education maybe, and some tips. So we've got Charlie Williams, fund manager at HB Biotech in Sydney. Is that right? In Sydney, Charlie?
That's correct, Analyst.
Yep. We've also got Rhys O'Connell, fund manager for merchant funds in Perth. And we've got Tara Speranza, a healthcare analyst at Bell Potter. My name's Mark Pachacz. I'm editor of Bioshares. I've been putting Bioshares together for about 22 years. So we're up to edition 935. We've got a new website now as well. So there's a lot of more free information on our website. So if you just go to bioshares.com.au, there'll be more and more helpful info there for everyone. So it's a very interesting and I guess challenging time in biotech, in investments in general. I think I'd probably like to open by saying it's the sector's never really been as advanced as it has previously, and yet we're still facing a very challenging time. I know at the start of the year it was always going to be a challenge to do well with your investments given the choppy global markets. My view is always going to be one, a real stock pickers market where stocks will move based on some pretty strong developments, and we saw that probably one of the biggest developments you could possibly say in the last decade with Neuron Pharmaceuticals having had their drug approved by the FDA through their partner Acadia Pharmaceuticals for the treatment of Rett syndrome. So this is this is a really important, I think it's a really important development in that it's one of the first drugs from Australasia that's gone from a lab in New Zealand all the way to the market in the US. Will be launched next month, and the potential to become blockbuster drug. So that's got to be good for the sector. I wanted to open just with Rhys from Merchant Funds. Just Rhys, wanted to ask you, can you just sort of paint the landscape at the moment? I know we've all got an idea of how difficult it is out there, but just paint the landscape of just the broader equity markets, investment markets, and what challenges people are facing, not just in biotech, but in investments overall, Rhys.
Yeah, certainly. Thanks, Mark, and thanks for having us. I guess the last couple of weeks, probably saw the banking crisis in the US and globe and through Europe as sort of a key negative driver when there was, I guess, some green shoots sort of showing. The other key issues to equity markets has been interest rates and inflation. So has it been your typical inflation? This was driven from the Russia and Ukraine war predominantly, and interest rates have sort of steadily gone up to try and counter inflation, which has put a lot of pressure on non-income generating stocks, for example, the NASDAQ. So from our view, I guess, here at Merchant, we've sort of seen a bear market in biotech from about March 2021. That's when the NASDAQ really started to peel back. So I did a bit of research on the NASDAQ last week, and given that SVB Bank was heavily sort of involved in the tech sector in the US, I thought, how did the NASDAQ compare or fare in that period of volatility? Because generally you would see some fairly big losses. So the 10th of March, NASDAQ was 11,138 points. 11 days later, it's 500 points higher, 11,675. So given that week of uncertainty we had last week, you've actually seen the NASDAQ gain. And there's two reasons, I think, for that. One could be that it's already heavily discounted. We've already had 2 years of sort of negative pricing in the NASDAQ and stocks being sort of already on their lows. We've come off 16,000 in the NASDAQ all the way down to 10. So around these levels, investors might be seeing value. The other point could be interest rates. Maybe the market's pricing interest rates will be cut. So that's going to be really good for our sector, given that cost of borrowing is going to be cheaper. It's easier to raise money in a lower interest rate environment, as we all know. So the way I sort of see it at the moment is we've been in this biotech bear market for a period of time. So there's some real buying opportunities out there. I don't know what the future holds. So I don't know whether our market goes from strength to strength, or whether, there is further capitulation from retail and institutional investors, and we see further losses. But if you look at the NASDAQ as an index over the last week, it's actually performed really strongly in a really volatile period, which you wouldn't have seen previously. And the other point is, when there's major negative sentiment, when everyone is bearish, generally the opposite happens. So we're quite contrarian investors at Merchants. So we tend to invest against the status quo. In 2008, you saw this was the global financial crisis was a real shock to everyone. It sort of came out of the blue, except for a few smart fund managers that became famous on the back of it. You did really see, everyone was super bullish. At the moment, you've got major negative sentiment across the board. So everyone is pricing in things to go lower, and things have already sort of pared back. You saw big pharma about a year ago, big tech and banks start slashing jobs. So their balance sheets are better than they were in the previous financial crisis in 2008. They've tried to get in front of the curve. If the recession happens, they've cut jobs and aggressively cut jobs, a year ago rather than at the moment. So to answer your question, I guess the banking situation globally is obviously what everyone's talking about, and it's what people are fearful of. Interest rates and inflation. So that'd be the three key points. I think you're exactly right, Mark. It's a real stock pickers market. If you pick the right stock and you're willing to invest over time, in biotech, you have to take a view over a period of time. You can't just get in and out and hope that things will go well. You have to invest and let the company come together and to deliver. So I think you're spot on. It's a stock pickers market. You pick the right stocks. There's real value out there.
Charlie, can I ask you a question? I was speaking to you this morning, and you were saying you invest both in Australian and US biotechs, 80-20 split, 80% in Australia. How do you see the
other way around? 80% NASDAQ.
Oh, is it really? Okay.
Yeah.
Okay. So, all right. So, how do you see the difference in the market, or do you see a difference in the biotech markets between the US and Australia?
It's an interesting question. You don't get to too many Australian conferences without hearing there's an arbitrage between valuation of Aussie biotechs and their NASDAQ counterparts. I think there is always that discount here in Australia. And part of that is, the US, they do like to invest in the local companies, and you'll even see the ADRs that are trading on the NASDAQ. They even tend to trade at a bit of a discount to the local shares. But in terms of how we're seeing investment in it, I couldn't agree with Reece more that it's absolutely returned to a stock pickers market. And fund managers who do the work to concentrate on the fundamentals of the biotechs, they will get rewarded. So it's really turning into a have and have nots kind of market at the moment. The companies that have some quality data, and especially coming into this credit crunch that we're potentially seeing, a big focus for us is capital adequacy for the biotechs we invest in. Balance sheet is of utmost importance in these periods of uncertainty, and you'll find the ones that have adequate access to capital plus some good data. They're really getting rewarded. We've seen recently, you mentioned Neuron, obviously great data, they're getting rewarded in stock picker market, but ones that, don't have a catalyst for a period of time and maybe undercapitalized, you're seeing them drift sideways. And so, that's one of the big things that we're looking for is, cash adequacy.
So question for Tara. Tara, I think you're muted at the moment. Oh, you're unmuted now. So Tara from Bells, and I know you're not on the investment banking side, you're an analyst. The Bells are the most prolific fundraiser or capital raiser in Australia. How important is capital backing when you're looking at stocks at the moment? Is that a real risk? Is that something that the companies should have had sorted out by now, or they're still not, and they're really being penalised? Or how do you view that, Tara?
Yeah, thanks you for having me here today, by the way, Mark and NWR. It's a pleasure to be here. Yeah, look, I would agree. If we talk about sort of the 2020 to early 2021, that might not have been a problem when there was cash flowing freely. You know, people were focused on healthcare markets because of the great gains we got in vaccine making, and everybody thought, oh, this is the future. And then all of a sudden things dried up as you know, we've talked about, Reece talked very well about some of the things that have affected the markets recently, especially over the last 18 months. And I think, yes, I'll add to Charlie's points, capital, a good asset. And I would also add to that good management. So what we're seeing is management that have got, you know, have put in place the right risk, things to manage their risk going forward, which includes the, you know, speaking to getting their registry correct, getting their long-term holders on there correctly. This is really important because at the moment, the volatility that we've heard about is making it really difficult to do things like raises. So yes, while Bells was very good with doing the raise and took over 60% of the biotech raises that occurred last year, the fact is that overall it was down compared to previous years. And that's because I think a lot of fund managers, and perhaps Reece and Charlie can, you know, talk to this a bit more than I, the risk that people are willing to take right now is a lot a lot lower. So I just think that having their own structures in place, having thought about, you know, we've seen a couple of companies do things like move to convertible notes rather than going to the market, or finding other ways, selling off some capital perhaps, if that's, you know, PP&E, for example, or I've seen some very interesting deals along selling back equipment to partners and then leasing it back from them with a, you know, on a good value over a certain number of years. But we never know the intricacies of these kinds of deals, and does that mean that the company is therefore going to have to reduce their gross profits, for example? You know, they'll never tell us that, and they're not required to tell us that. But, you know, these are the sort of things that I am concerned about in a market like this. So I think if a company can come along and, like Charlie said, have you know, good cash in the bank and have a good asset, which is always good, but even having a good asset is not enough by itself. You know, we've seen that time and time again. That smaller, sort of think about companies that have had good assets for a long period of time, that have even got partnerships with tier 1 pharma with some of their assets, still not getting any traction, still losing money. We see that the losses over numbers of years are into the hundreds of millions, and this is always a big problem going forward. So yes, I think that that's where management comes in. So I think that's the third thing we need to be looking at.
So I'm wondering when things will start to improve for the sector, I guess, for investment markets overall. I've previously looked at cycles in the biotech sector. It tends to go in these 4 to 5 year cycles, you know, starting from 1983 or so. And I guess if you look at that, then maybe, you know, end of 2024, early 2025 is when the next cycle in biotech will occur. Putting your crystal ball on, when do you think things are going to get better, or is that really going to be based on some macro events? Reece, do you want to?
Yeah, I guess there's a bit of both. Like Neuron was great for our sector. I really like that. TLX last year. So I guess it's you have a couple of wins in the local market outside of what's happening in the US. That generally leads, because money it brings investors back to a sector that's downtrodden. Oh, okay, maybe I should be looking. Is this the next Neuron? You know. Or is this the next TLX? And those sort of, you probably need a positive run in a couple of stories. Neuron was great for us last week. I tend to agree with you. It's sort of a 3 or 4 year cycle. And the macro, you know, global macro market will affect how quickly that happens. You know, it could be sooner. If there's more cash and we go back into a strong market, probably the most value across the board is probably in the biotech market at the moment. So that could happen sooner than the 3 or 4 years.
It's a strange dichotomy. I was speaking with Tara yesterday, and I think, Tara, you were saying that even though prices are low, investors don't want to invest now. They're waiting for prices to, like, things to, I guess, the mood to improve and outlook to improve before they start to put the money back into the sector. Charlie, do you think the US investors are more resilient when it comes to, you know, you have a down wave in a biotech, and they're quick to get back into it. Whereas in Australia, that's more of a trough than in terms of bouncing back.
Yeah, so Mark, that's an interesting question, and I think the US is structurally a little bit of a different market. In my mind, I sort of split the types of investors between specialist biotech investors. We know some of the names from the registers here, like a BVF, that only invest in this sector. Then you've got generalist hedge funds over in the US who do also invest in biotech. And then you've got retail. But if you like, the US market is sort of dominated by that institutional, their registers are very institutionalized. Whereas, you'd say it's almost a greater retail on the whole in Australia. And so, what you do see in these times, the specialist biotech investors in the States are very quick, and they're quite happy to invest in the downturn. Their hedge funds probably follow their close followers, and then you see the retail sort of pick it up into more as it's kicking along and it's got a head of steam. But to your point before, it's a very interesting. Illisted markets are a funny place. It's about the only store where when everything goes on sale, no one wants to buy anything. Yeah,
I guess Australia is more dominated by retail investors. So they're, as you're saying, if they're the last ones to sort of help bring the market back, then Australia will take longer to respond.
Look, that could be the case, and it's always a fun time. You always have clients when the market goes down, they get a little bit nervous. But looking back to the lows in the biotech market of May last year, it was really getting ridiculous. A quarter of my universe by number of companies were trading at or below cash. It got to a stage where it was ridiculous, and you put the scan on it, say, pick something that's trading at or less than cash backing, what has interesting science, a catalyst in the next 6 to 12 months, great management, as you said, Tara, that is an absolute must. And you can pick the eyes out of these things, but this is the opportunity when things go down. Will things get cheaper? No one knows. But if you can see value for the longer term, and could be talking 12 to 24 months, you'll probably do well to be picking the eyes out of some great companies in these weaker markets.
Okay. We saw recently a couple of weeks ago, Cox that came close to being acquired. Are we going to start to see some M&A activity, guys, in the sector? We haven't seen too much over the last decade, really. I think it was Certex, and I'm not sure what else there's been, but hasn't been too much. And I would have thought, as the industry matures, that the companies are becoming more mature, that they will become more attractive acquisition targets. But we're still not seeing it. Do you think Tara, do you think we're going to see any of that in the next couple of years?
So the first thing I want to say about acquisitions is that it is the goal of a lot of smaller biotechs in Australia, for example, but it's you have to remember it's very competitive. So if you think about the number of small biotechs over in the US, they've always got first access to the table for tier one pharma, for example. So the idea of just being acquired being one of the things that you can do is a little bit of a fallacy that I think that people have to recognize. Yes, it's a good goal, but it is very competitive. So you might have a good asset, but I can assure you that there are 20 other biotechs in the US that have a very similar asset. So you need to start. What's happening now is we're seeing less early acquisitions, and what we're seeing is acquisitions occurring after good data has come through from even phase 2, maybe the start of phase 3 data, if not after that. So this is something that I think has changed over maybe the last decade. So the competition makes it tricky, 1. 2, Big Pharma, you talked about layoffs in other sectors. Big Pharma have had huge sways of layoffs over this year, in the first 3 months of this year. Now, what's strange about that is that they seem to be rather pregnant with cash if you look at their balance sheets. So what are they doing? Are they looking to acquire? What are they going to do with all that cash? Or is it going to R&D? So we don't know the answers to those, but that's the sort of thing that you want to be looking at. I think that what do we have? 2018 was Viralytics. That was probably our last big acquisition over here in Australia. That was terrific. But now we've heard that Merck have shelved that product. So, and the reason they've shelved it is because they're moving away from that, and they're looking at moving, into perhaps rather than viral oncolytics, other types of oncological drugs. So They're looking at things like improving the shelf life of their patients with things like Keytruda, for example, or so they want another immunotherapy to whack in with that. Or maybe they're looking at CAR Ts. You know, there's only 5 or 6 CAR Ts that have been approved, so that's another big market. And then thinking about, we've talked about Telix recently, that's another one. So we've got, you know, Telix, Novartis with their big radio pharmaceuticals that are used for imaging, but what they want to do there is go for a therapeutic. So I think that we have to be careful about how easy it is for a company to be acquired, and it shouldn't always be the goal. So another thing to remember there is that rather than just acquisitions, I think we should be thinking about licensing. So single asset licensing is probably more common than full acquisitions.
Okay. I'll put you on the spot. Do you think Neuron's an acquisition target, Tara?
No. So
No.
I think what's happening with, no, I don't, because it's going to be too difficult the way they've structured their deal with Arcadia. So Neuron have their first drug, trofinetide, which is now being branded Daybue. You know, great news. A week and a bit ago, it was approved by the FDA for full use in Rett syndrome, everyone 2 years and older. So mostly girls, obviously, with Rett syndrome. So this is wonderful news. We know, you know, Neuron are going to enter the ASX 200 very shortly. And another point I would like to make about that is this terrific news. I agree with both Reece and Charlie, great for the sector, you know, really boosts confidence in the sector and tells us that these things can happen. So what's good about this is that we're, you know, having another one of these biotechs enter the ASX 200 means that big funds that followed this index are now going to have to jump on board. And not only are they going to have to jump on board, it'll go in with a weighting of a bit below 0.5, I'd say. So, but what's going to happen is once it goes, it'll keep moving up, and funds that follow the index are going to have to push up their holding of Neuron in order, you know, if it hits 1% or above, or they're going to miss the index. So, you know, that's a really good thing for our sector too, to have another drug moving up and with its weighting in the ASX as well. So I just want to make that point. But no, it's not a target. So they've got this deal with Arcadia, which is what I would call a small to mid-tier pharma. So Arcadia don't have the resources to take it rest of the world, nor do Neuron seem to have any aim to be signing a rest of world deal with Arcadia for trofinetide. So they're looking for another partner to take trofinetide to rest of world. And that might actually be difficult for them to do, given that Arcadia have the US market, and that's the market that everyone would want to take a drug to. So whether or not people are going to continue to be interested in taking trofinetide to the rest of the world is frankly still a question. I'm not trying to be negative about it, because in Neuron's case, it's not a big deal. They have this second drug coming through the pipeline. It's entered phase 2 trials for 3 indications, and it's about to start in a 4th indication. I won't go into the details, it's very easy to look up if you want to. The people over at Neuron are saying that this drug is even better than trofinetide with its mechanism of action, much more clear, and the outcomes in the preclinical studies being better. So here we have that situation that I talked about, where rather than a full acquisition, what we're looking at is licensing of individual assets, perhaps just even to different regions of the world. So no, it's not a target for full acquisition, but yes, licensing of individual assets.
How do you think that drug, it's called Daybue now, trofinetide, will go with pricing in the US, and what hurdles remain for them with respect to pricing for Daybue?
Okay, so Arcadia have come out and said that they're aiming for around about 380 thousand per patient per annum. For me, that's a little bit high. So let me just say the average rare drug pricing is around about the 180,000 mark per patient per annum. Remember that the US government at the very end of last year passed a law that allows CMS to negotiate prices. So previously they couldn't, and now they can. So going in at such a high price could be an issue. We saw what happened with aducanumab. You know, they got a lot of flack for their pricing, and then CMS didn't even approve it in the end. So I'm doing the typical analyst thing. And by the way, my background is as a research science. I'm a molecular biologist. It's very normal of me to break things down into, you know, the sum of parts, shall we say. So they still need to negotiate with CMS on first of all, approval for reimbursement and pricing. So these are 2 things that we're going to be looking at. And from what I understand, Arcadia have a register of patients with Rett syndrome in the US, and 60% are CMS patients, so Medicare, Medicaid. So the older one, there's a few that'll be over 18 that will be on the typical Medicare. And then the rest are private patients. So that'll be a separate series of negotiations with private insurers, and then the 60% with CMS. So these are the hurdles. CMS have, are taking a pretty hardline position at the moment with pricing and also approval for reimbursement. So it's still not over the line. So I just, I don't think they're going to have a big problem. I do think they may have overpriced, but that's what you do when you go into a negotiation, isn't it? You go in with your highest hope and then you negotiate down. So I'm not saying it'll be lower than 180, but I'm just saying that maybe 380 is a bit high.
Okay. I wanted to finish up with perhaps some learnings from investing in biotech, and perhaps what are some of the companies one or two of the companies that you might like that fit in with these learnings or your investment philosophy. For me, having covered the sector for 20 years, it's a couple of the key learnings for me have been the importance of the CEO. When I look at three of the successful companies in Telix Pharmaceuticals, Clinuvel, and Cogstate, they're led by very, very determined CEOs, and I think that's become an important factor for me looking at companies. Also, someone once talked about the need to reassess a company, and Neuron was one of those where it sort of fell off our sites for a number of years, and then we went and reassessed it, and it's been fantastic. So I wanted to ask, perhaps to start with Reece, just one or two companies that you might want to talk about that you like, why you like them, and or if you have any learnings from investment in general or investment in biotechs, Reece.
Yeah, spot on. So to your point and to what Charlie was saying earlier as well, it's like management is totally key. So our best two performers the last couple of years have been Race Oncology with Dan Tillett, absolutely exceptional, and Polynovo with David Williams, absolutely exceptional MD. So the assets are good. So in sort of the mid-tier, our favourites, Race Oncology again. Dan Tillett's got 9.9% of the company, phase 2 asset, full of cash. The phase 2 assets, first in class, best in class, FTO inhibitor, can really run on the back of Neuron's news last week. Great management, full of cash, good asset. So really it's the market that's been pricing it down. So we really like that. And you get confidence backing a team like that that's delivered for you already and has always done what they said they would. If I go down the curve, there's a really good asset that I like in Aravella. So it's iNKT cell therapy. There's only 4 of them alike globally, but it's early. So Race is up the curve, de-risked somewhat, and good management. We've got a new chairman in Aravella, but they've interestingly enough, they've got in the animal models that had secondary remission in all 4 animals, and you might have the presentation in this. It'll be well worth a watch. But there's that, and then the second part to Aravella is the off-the-shelf potential in CAR T. So proof of concept that you can be an off-the-shelf CAR T, so you don't take the blood out of the existing patient, which is what they do in CAR T. You'd be, in a fresh donor's blood, and you'd be straight into a client's, not a client, a sick patient. So that's the reason we invested in that, 18 months ago. Really exciting technology. So that'd be 2, sort of one down the curve, one up the curve. But there's value across the board. You're totally right. It's management's a critical part to this, especially early.
Reece, you want to talk about one or two stocks? It could be the US or Australia that you like, and why you like them, how that fits into your investment philosophy. Charlie, sorry.
Yeah.
Sorry.
So I mean, it's interesting hearing, so the approaches and management's critical, the assets critical, and I guess one of the philosophies that we always look to when investing is, firstly, there are always far more good assets than there are good businesses. And important into that good business is run by quality management, but there's also far fewer good investments than there are good businesses. And so, it's this focus all the time of what constitutes a good investment at any point in time. And Mark, you mentioned, the idea of going back and reassessing a company and investment. And that's, you know, if you look at it from a first screen, everything we do is have a look at, is something a good investment? Does it screen out as a good investment first? And although in biotech you spend almost all your time, or so much of your time in due diligence looking at the asset, have you got a good asset? It's almost a ticket to play, because if you don't have a good asset, you're not going to look at it in the first place. And so, you know, taking that philosophy, and you look through, I'll restrict my conversation to ASX shares. I think most people on this are probably more interested in ASX than you know, what I'm seeing on the NASDAQ. You know, if you go through that, you know, looking for a good bang for buck in terms of risk reward profile, Clarity Pharmaceuticals stands out for me at the moment of one of the Australian shares. You know, you step through that, you know, they've got some very interesting assets in terms of this copper perfect pairing. Very strong rationale as to, you know, why it should work. You've seen a lot of success in something like Telix. You know, I'd argue sort of from an investment perspective, you've got a great bang for buck, you know, in terms of looking at Clarity. You look into the good business, you've got a team there that's a lot of them ex-Algeta. Now, Algeta took one of the first radiotherapies to market in Xofigo. You know, so they actually understand what it is to bring a product to market. And that was, so Algeta was sold to Bayer, where it was eventually commercialized. And you get back up to the top end of, you know, does it look like a compelling investment opportunity? And, you know, the answer for us is clearly yes. You know, and if you put that philosophy across a bunch of different stocks, it really helps your thinking as to where we will make money as a good investment, as opposed to falling in love with the asset, which is very easy to do in biotech.
Yeah. Thanks, Charlie. We're going to wrap up there. Tara, have you got a favourite of the stocks that you analyse?
Yeah, I mean, I'm going to stick with pure biotech rather than sort of healthcare ones that I think are doing well, too big perhaps for this discussion. But just a couple of quick ones. I'm going to call out Immutep. I think they're doing really well. Thing about Immutep is they've got 3 really good indications for a single asset, plus they've got a bunch of other assets that they've already out-licensed, and 2 of which they haven't out-licensed. Again, these are immunotherapies. I think, you know, I mentioned before that these are important sort of targets for big pharma to put in combination with their current immunotherapies and increase the shelf life or the patent life to stop generics coming on board and taking over those, you know, what 50 billion revenue incomes each year that they get from things like Keytruda and whatnot. Well, the numbers wrong, but much higher than that actually. And the other one I want to point out right now is Microba. Now, I like Microba at the moment. They're way off with their therapeutic asset, and I've got my keen eye on that. I don't value any in my models. I never value an asset that hasn't been put into humans and we don't have safety data yet. So no actual value given to that, but I've got a keen eye. I'm very interested. Ferring recently had a first biotherapeutic approved by the FDA for a very different indication, but the fact is that it's that style of drug. We've seen a first approval over in the US. And what I like about Microba is that on top of their therapeutic arm of the business, they've got a distribution arm of their test, their gut health test that everybody's interested in, a bit of a hot topic at the moment, but it's just growing, and they're going both for the kind of alternative medicine demographic as well as your, you know, Western medicine. They've got a huge deal with Sonic. Sonic have taken a 20% stake in the business, plus given them cash, as well as their medical director as one of their scientific advisors now, which is terrific. And what we're seeing is co-localized distribution agreements. So you've got your Sonics, and then you've got your alternative healthcare distributors in the same localization, especially, you know, in the US and Australia, Europe, the UAE. Frankly, the only part of the world they're missing is Asia. And I just think the distribution rollout that these guys have done has been incredible.
Right. All right. Excellent. Thanks for those tips, guys. We better wrap it up there. We're over time. All right. Thank you very much to our panelists for participating, and hope everyone out there enjoys the rest of the NWR Healthcare virtual conference. Good on you. See you later.
Thank you for having me.
Thanks, everyone.